Investing for beginners. Choose a strategy based on how much money you put in, how long it will take you to reach your goals, and how much risk you're willing to take. The information in this video about investing is for entertainment purposes only. Please do your own due diligence as I'm not a financial advisor. Steps. Start investing as soon as you can. Decide how much to invest, open an investment account, choose an investment strategy, and know what your options are. Planning a strategy for investing. So when you're just starting out, rent, utilities, debt payments, and groceries might seem like all you can afford. This is especially true when inflation makes bread, gas, and homes more expensive than they used to be. But once you've set up a budget for your monthly bills and saved at least a little money in an emergency fund, it's time to start investing. The hard part is figuring out where and how much to put your money. As a beginner in the world of investing, you have a lot of questions such as, how much money do I need? How do I get started? And what are the best investment strategies for beginners? This guide will answer these and many other questions. Start putting money away as soon as you can. One of the best ways to get a good return on your money is to start investing when you're young. That's thanks to compound earnings, which means your investment returns start earning their own return. With compounding, your account balance can grow quickly like a snowball. People also often wonder if they can get started with a small amount of money. In short, yes. Investing with less money than ever before is possible thanks to low or no minimum investments, no commissions, and fractional shares. Index funds, exchange-traded funds, and mutual funds are all types of investments that can be made with small amounts of money. If you're worried about whether or not your contribution is enough, think about how much you can afford to give, given your goals and financial situation. Let's say you invest $200 a month for 10 years and get an average 6% return each year. You'll have $33,300 at the end of the 10 years. Of that amount, $24,200 is money you've contributed, those $200 a month contributions, and $9,100 is interest you've earned on your investment. There will be ups and downs in the stock market, but if you start investing when you're young, you'll have decades to ride out the bad times and watch your money grow. Start right away, even if you have to start small. Decide how much to invest. How much you should invest depends on how much money you have, what you want to invest in, and how soon you need to reach your goal. One common investment goal is retirement. As a general rule of thumb, you want to aim to invest a total of 10% to 15% of your income each year for retirement. Right now, that might sound impossible, but you can start small and work your way up. If you have a retirement account at work like a 401k and the company matches your contributions, it's easy to reach your first investment goal. Put at least enough money into that account to get the full match. That's free money, and you don't want to miss out on it, especially since your employer's match counts towards that goal. For other investment goals like buying a home, getting a life-changing surgery, traveling, or going to school, think about how long you have and how much you need, then work backwards to figure out how much you can save each week or month. Start a savings account. You can save for retirement in an individual retirement account, like a traditional or Roth IRA, if you don't have access to an employer-sponsored retirement account like a 401k. If you're investing for something other than retirement, you probably don't want to use a retirement account. These accounts are meant for retirement and have rules about when and how you can get your money back. Instead, think about a taxable brokerage account from which you can take money out at any time without paying extra taxes or fees. Brokerage accounts are also a good choice for people who have contributed as much as they can to their IRAs but still want to invest. This is because the contribution limits for IRAs are often much lower than those for employer-sponsored retirement accounts. Choose a way to invest. Your investment strategy will depend on what you want to save for, how much money you need, and how long you have to reach your goals. If your goal for saving is more than 20 years away, like retirement, you can put almost all of your money in stocks. But picking individual stocks can be hard and take a lot of time. For most people, the best way to invest in stocks is through low-cost stock, mutual funds, index funds, or ETFs. If you're saving for something you need in less than 5 years, you're better off keeping your money in a safe place like an online savings account, a cash management account, or a low-risk investment portfolio. If you can't decide or don't want to, you can use a robo-advisor. That's a service that uses computer algorithms to build and manage your investment portfolio, to open an investment account such as an IRA. Most robo-advisors' portfolios are made up of low-cost ETFs and index funds. Robos make it easy to start quickly because they have low cost and low or no minimums. They charge a small fee, usually around 0.25% of your account balance, to manage your portfolio. Find out what you can do with your money. So after you decide how to invest, you need to decide what to invest in. Every investment has some risk, and it's important to know how much risk each one has and whether or not it fits with your goals. Most people who are just starting out choose to invest in stocks. A stock is a piece of company's ownership. Equity is another word for stocks. The price of a share of stock can be anywhere from a few dollars to a few $1,000s depending on the company. We suggest buying stocks through mutual funds. Bonds. A bond is a loan to a company or government agency that promises to pay you back in a certain amount of years. While you wait, you get interest. Bonds are usually less risky than stocks because you know exactly when and how much you'll get back. But bonds have lower returns over the long term, so they shouldn't be a big part of a portfolio of long-term investments. And then you have mutual funds. A mutual fund is a bundle of different investments. Mutual funds let investors buy a diverse group of stocks and bonds all at once instead of picking out each one individually. Mutual funds are usually also less risky than buying individual stocks because they are made up of many different stocks. That's why these are my favorite. Some mutual funds are managed by a professional, but index funds follow the performance of a certain stock market like the S&P 500. Index funds can charge less in fees than actively managed mutual funds because they don't have a professional manager. Most 401ks have a carefully chosen list of mutual or index funds that you can invest in with no minimum. However, if you invest in these funds outside of a 401k, you may have to put down $1,000 or more. Now let's talk about exchange-traded funds. Like a mutual fund, an ETF is a group of many separate investments. ETFs are different because they trade all day long like stocks and are bought for a share price. Most of the time, an ETF's share price is lower than the mutual fund's minimum investment amount. This makes ETFs a good choice for new investors or those with small budgets. ETFs can also be index funds. So, how much money do you need to get started? You don't need a lot of money to start investing, which is good news. Most online brokers have no account minimums to get started, and some offer fractional share investing for those starting with small dollar amounts. For just a few dollars, you can purchase ETFs that allow you to build a diversified portfolio of stocks. You can start investing with micro investing platforms that even let you round up purchases made with a debit card. So here's the bottom line. If you're just starting out in the investment world, make sure to consider your risk tolerance and what your financial goals are before committing money to an investment. Some investments like high-yield savings account make it easy to get money quickly in case of an emergency. Stocks, on the other hand, should likely be part of a long-term investment plan. Many beginning investors also turn to robo-advisors, which we talked about earlier, where an algorithm automatically selects and manages a diverse portfolio of exchange-traded funds for you based around your individual financial needs and appetite for risk. Happy investing. Go make that money, build wealth, and build a purposeful life. Don't forget to like and subscribe, and see you in the next video.